Understanding the federal funds rate, overnight cash needs. In the next few minutes, we will explore the concept of the federal funds rate, specifically focusing on its purpose, determination, and influence. The federal funds rate refers to the interest rate at which depository institutions trade federal funds with each other overnight. It is an essential tool used by the Federal Reserve to manage the economy. Let's delve deeper into this topic. What is the federal funds rate? The federal funds rate is the interest rate at which banks and other depository institutions lend and borrow funds from each other on an overnight basis. It is a short-term borrowing rate that plays a crucial role in the overall functioning of the financial system. Determination of the federal funds rate. The effective federal funds rate is determined by the market forces of supply and demand. Banks negotiate and agree upon a rate at which they are willing to lend or borrow funds from each other. However, the Federal Reserve has the power to influence this rate through its open market operations. Open market operations. Open market operations refer to the buying and selling of government securities by the Federal Reserve in the open market. When the Federal Reserve wants to decrease the federal funds rate, it buys government securities from banks, injecting cash into the system. This increases the supply of funds, making it easier for banks to lend to each other at lower interest rates. Conversely, when the Federal Reserve wants to increase the federal funds rate, it sells government securities, reducing the supply of funds and making borrowing more expensive. Maintaining a target range. The Federal Reserve aims to keep the federal funds rate within a specific target range. Currently, this range is set between 0.25% and 0.50%, or 25 basis points. By controlling the federal funds rate, the Federal Reserve can influence borrowing costs, which in turn affects consumer spending, investment, and overall economic activity. Importance of the federal funds rate. The federal funds rate serves as a benchmark for many other interest rates in the economy. It affects the rates at which consumers and businesses can borrow money, impacting various financial products such as mortgages, auto loans, and credit cards. Changes in the federal funds rate can also influence the value of the US dollar and impact international trade. Conclusion. The federal funds rate plays a vital role in the functioning of the financial system and the overall economy. It represents the interest rate at which depository institutions trade federal funds with each other overnight. While the market determines the rate, the Federal Reserve has the power to influence it through open market operations. By maintaining a target range, the Federal Reserve can control borrowing costs and stimulate or slow down economic activity. Understanding the federal funds rate is crucial for investors, policymakers, and individuals alike, as it impacts various aspects of the economy.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.